Welcome to Financial Revelations. I am David Safransky, your host. As always, that's never going to change, most likely. You can reach us at 1-800-344-2534, at SkiBucks1 on Twitter. And remember, on Thursday mornings, almost every Thursday morning from 8 a.m. to 9 a.m., I'm on WCRF 103.3 in Cleveland. And if you have a smartphone, I just saw an article about people moving back to dumb phones. But if you maintain your smartphone, you could download an app and you can listen to me anywhere that you have connectivity. So that's exciting for you guys. I hear myself all the time, so I don't need to hear it anymore, but you need to get more of this. And then, of course, it'll be scrolling below me if you're watching the video feed. Some people don't watch the video. They just listen to it while they drive or, I don't know, go to the bathroom, whatever they do. But today is the end of the first quarter of 2023. The year is broken up into 4 quarters, 3 months each. And a lot of money managers, a lot of people who do what I do, are judged on the quarter. So the quarter closes tonight at 4 o'clock for the market. And that's what you bill out on. So it's important. These things are important. And we're having a little bit of a run up into the end of the quarter, which I'm just glad to see people. I like to see people make money. You know, when you have a fee only practice, when you do better, we do better. And if we're doing better, that means you're doing better. And I like to see people make money. That's what I'm in this business before. You know, we've always acted in the best interest of our clients, but we want to see you make a lot of money. We want our clients to be stinking, filthy rich. That's the goal. So what have markets done this quarter? They've actually been pretty well behaved. We had the bank thing happen 3 or 4 weeks ago where it looked like banks were in trouble, and some banks are in trouble. That is not over yet. We're still in the midst of a war, and which is heating up. It's not cooling down. We've had the Fed be active and promise more activity. And, you know, the Fed is raising rates, but when the bank crisis hit, or the bank situation hit, rates fell dramatically. They fell 25%, which for the bond market is just incredible. I have not seen, I've been doing this for 30 years. I'm in my 31st year. I think I'm going to make it to 60 years in this business, just in case you're wondering. But in 30 years, I have never seen rates move as dramatically as they did when SVB Bank and Signal Bank got taken over. So and in the midst of all of these things happening, which are, some of them are fairly dramatic, the markets stayed within their range despite really all these incredible things. So when I say the range, there's this number that the S&P has not gone below, and also the Dow. Now the Dow is only 30 stocks, so it's not the greatest judge of what's going on, but it's still one of the judges that we use. So we have the Dow, we have the S&P 500, we have the NASDAQ, we have a lot of different things, but I really watch the NASDAQ, somewhat the Dow, and the S&P 500. Well, let's just use the S&P 500 for an example. It went down, yes, but it didn't get anywhere close to its support level. And I was really kind of surprised at that. And now we're going up, and we've gone kind of up and down in this range, and we have this resistance level that we can't break through. But because we didn't break through that lower support level, I think the next move up, now I will talk about this in a minute, what's going to happen in the next couple of weeks, but if we don't have a lot of downside surprises, so companies come out and say, oh, not only did we miss, but we're restating and, you know, all that bad news, I think the next move could be out of the range to the upside. It's possible. It's totally possible. I would have thought for sure that some of the things that the Treasury Secretary, Janet Yellen, said, and some of the things that the Fed Chairman, Chair Powell, said would have broken us to the downside. And we didn't even really get that close. So I kind of like the action. It tells me that the support is strengthening to the downside. Now, anything could happen. So we could, there could be a black swan event, but I pray that there isn't. But there always is a black swan event. One of the things, too, computers can wreak havoc on a portfolio because there are short sellers out there. Short sellers make money when a stock goes down, and what they do is very simple. They borrow a stock. They pay interest for that. They sell the stock. Okay, so they get borrowed stock, they sell it, and then they buy it back at a lower price. So they hope that the stock goes down. So the next couple of weeks will be earnings season starts, and I'm going to be very, very interested to see what the off-balance sheet losses are in banks if they disclose these things, because a lot of banks have losing bond portfolios. So right now, the short end of the curve is much higher in rates. So banks don't generally buy at the short end of the curve. They might buy at the short end of the curve like 2-3 years, but they're loaning at the long end of the curve, and those rates are lower. So they're losing money on every loan right now. And I want to see what their off-balance sheet losses look like. And then this is where the computers come in, because a lot of the short selling happens on program trading. It's a brokerage house says, hey, if a stock does these 4 things, you short it, you keep shorting it until that stock is zero. And computers they have no feelings. They don't care about your portfolio. They care about walking out that algorithm that they've been programmed for. And so there are people looking for the weak banks out there right now. So what do I think of the second quarter, which is going to start Monday for us? I think it could be a rough beginning. It's not uncommon for a little bit of a buildup into the end of a quarter, because money managers are trying to this is when they bill, so they got to get those numbers up. And then you kind of turn the page on a new month, and all of a sudden, oh, well, we got 3 months to get that done again. And so the bottom kind of falls out a little bit. And I think that could very well happen in the beginning of earnings seasons. A lot of banks are first to report, and some of them are going to report some pretty bad news in their balance sheet. Now, the Fed has done some things to shore them up. They are allowing banks to take out some short-term, very low-cost loans. But these loans aren't like $1 million. They're like $1 billion. SVB Bank went from a $40 billion bank to a $200 billion bank in roughly 13, 14 months. And they lost $1 billion in 4 hours. So these things happen really fast. And the Fed needs to get out in front of it, because a bank like SVB could have brought down the banking system. And if they're big enough to do that, we got to watch them. And I do think it was a failure of regulators to a large degree, but I think it could be a rough beginning to the earnings season. So, don't get too disheartened if we kind of get close to that lower end of the range. I also think that the Fed is going to raise rates 2 or 3 more times. I don't see any way that they can't. They don't have a meeting in April, so Chair Powell has the month off. He's probably going someplace warm where they won't recognize him, but people follow him everywhere. So I once flew on a plane with the bank president, the federal bank president of Cleveland, Loretta Mester, and I saw her standing there, and I introduced myself, and she was surprised that I knew who she was, but why wouldn't I not know who she was? And I said, hey, where's your security? She didn't have any security. They don't have private jets. She was in a middle seat at row like 36. But I wasn't giving her my seat. I know that. I was up front. And anyway, I think the Fed is going to go May, June, and July, 25 basis points. And I think they're going to stop. The damage will be done. We're going to be much closer to a recession. There's no guarantee that we're going to have a recession, but it's hard for me to kind of quantify all the things that the Fed has done with the bank credit kind of tightening up a little bit and not see some type of recession towards the end of the year. it's almost inevitable, but it's not 100%. But it does look like we're going that way. But I do think there's going to be bright spots. There's going to be bright sectors that will shine. For instance, technology has done really well this year. So one of the theories, the dogs of the Dow, is you from last year, whatever performed worst, that's what you buy because it's going to revert to the mean this year. And I think in some sense, technology has done that. But as we get further and further away from the pandemic, microchips are being delivered, cars are being made, so that energy flow out of technology for balance sheets and things like that, it's really happening. So they are making money. And so I think there will be bright spots in the market. And this is where I tell people, this is where we really make our money. It's in the portfolio tilt. So let's say that technology is, and I'm just picking a number, 17% of the S&P 500. Well, the tilt would be to be 19% in that asset class, not in one company. You can't put 19% of your money in one company. It's not prudent to do those things unless you protect it. So let's say you bought Apple at $20 a share many moons ago, and now it's 160, with splits and everything. So now you've got 15% of your money in there. You got to do something to protect it. So you buy a put, you have not necessarily all of it. You don't have to sell out of all of it, but you should be protecting some of it. So I wanted to get to one listener, viewer, reader question, and that is that they asked me, why do I always recommend Roth IRAs for younger people? And the truth is, I don't always do anything, but I do frequently recommend Roth IRAs or Roth 401ks if you have that option, especially the younger you are. And with the Roth tax law, I really do think that Congress does not realize what it did, because they're going to lose a lot of tax money. They're after tax money now. They want to raise taxes. The Inflation Reduction Act actually is going to cost about 3 times more than what we were promised. So they're going to need even more tax money. And President Biden's new budget, get this math, ready? He lowers the deficit, the debt, by $3 trillion, but in 20 years we have $51 trillion in debt. So I don't know where that math works for you, but that must be that new math we've been talking about so much lately. But the thing about a Roth that I love is that the money goes in after tax. So it's right out of your checkbook, but it grows tax deferred. And there's this rule called the rule of 72 in finance, where if you take the number 72 and you divide the interest rate into it that you think you can get, so I'll use 12% because it's easy math for me, your money will double every 6 years. So every 6 years you fold that money over again. Well, think about that happening over the course of 20, 30, or 40 years. If you start working someplace when you're 20, 22, and you retire when you're 60, 62, and you've contributed to that Roth 401k that whole time, your max, and you're getting somewhere around those rates, there's no guarantees of any rate that you'll get unless you're in the guaranteed interest account, and don't do that. But you could make a lot of money. And then, that's called the power of compounding, and there's no required minimum distribution on a Roth. And all the money that you put in that was already taxed, well, that's been taxed, okay? So that's always going to come out taxed with no tax on it. But all the growth in a Roth IRA or Roth 401k comes out tax-free, totally tax-free. And it's easy to pass on to the next generation. With the new rules with IRA beneficiary accounts, you got to have the money out of there in 10 years. Not so in a Roth if you're the beneficiary. So I really like the Roth tax law the best. Now, how old is too old to be in a Roth? Well, if you're still working and you're in your 60s and you have IRA money, traditional IRA money, I don't mind doing a Roth IRA at that point, because you're going to live to be 90. That's 30 years of compounding that you could have. Now, you're going to use some of that money, of course, before that 30 years is up, but let's say you get 20 years of compound. That's powerful. So I don't mind, even in somebody in their 60s doing a Roth, as long as they've done some other planning too. So when you sit down with a planner or you're planning your finances, think about it in a holistic approach. So, yeah, you're going to have some retirement. You're going to have emergency funds, which is your savings. You're going to have your insurances. You're going to do all these things. It's not just about the retirement date. It's not about any one thing. If you take a holistic approach to planning your retirement, you're going to be doing things that avoid the potholes along the way too. Now, if somebody's listening to this from Florida and they've lived there their whole life, they might not know what a pothole is, but you Clevelanders definitely know. And that's really my job. It's to help you avoid those big potholes so that you don't make just a classic error. So when you're doing your planning, definitely think about retirement planning, but think about all the other things that you're going to do along the way so that you can get to retirement with your finances intact. So you don't want to have to go into your retirement plan if you have an emergency, and that's why you have an emergency fund, right? You don't want to pay a credit card company a bunch of interest that I don't want to pay. It's like a leaky valve on a faucet. You're wasting money. So you don't pay. You pay off your credit card balances every month. There's a guy that he's in finance, pretty popular, very wealthy. He says nobody should own a credit card. I think that's horrible advice. Everybody should have a credit. Well, 96% of people should have a credit card. There's 4% that probably shouldn't because it's just not disciplined enough. But if you're disciplined with credit cards and you pay off the balance every month, credit cards can work in your favor. It's a great tool to have. So there's a lot of things that we could be doing planning-wise, but think of it as a holistic approach. If you do those things, you're probably going to retire successfully. You're probably going to live successfully. I am David Safransky, a real American, a true red-blooded patriot, and the voice you can trust.